Bank balance sheets just changed, and the market is about to find out the hard way, right when liquidity is thinnest. This isn't a bank crisis headline, and it's not a victory lap either. It's a warning from the plumbing. The kind of warning you only see when the system quietly runs out of slack, the incentives flip, and the cost of holding risk rises before the crowd even notices. And the part the mainstream keeps missing is that the price you're rewatching is not the real price. The real price is the balance sheet price. How much it costs dealers and banks to intermediate one more trade, finance one more position, warehouse one more bond. Because when that cost jumps, everything else follows. Yields, spreads, equities, crypto, even metals. Later in this video, you'll have a simple checklist for the next 1 to 2 weeks, the levels that matter, and the one confirmation signal that tells you whether this warning becomes a routine year-end wobble or the start of a much faster repricing. And the next detail is what flips the whole setup. What changed is not just what banks own. It's how they behave around reporting dates, how they ration balance sheet, and how the central bank just told you, without using dramatic language, that reserves are no longer comfortably abundant. That's why the shift matters. The Federal Reserve decided to stop letting its securities roll off the balance sheet starting December 1st, 2025, after signaling that money market pressures were showing up in the exact places they monitor when the system is getting tight. That's not a random decision, it's a tell. It's the kind of quiet pivot you only make when the machine is still running, but starting to grind. Because if reserves were truly plentiful and the plumbing was frictionless, you don't need to change anything. You don't need to preempt. You just let the runoff continue and you keep calm. But they didn't. And that's where the real pressure starts. Let's strip away the narrative version and talk mechanics. Banks don't run out of money the way a household does. Banks hit constraints, regulatory constraints, internal risk limits, liquidity ratios, leverage optics, quarter-end balance sheet window dressing, and plain old funding costs that jump when dealers and bank treasurers decide they've already done enough for the period. That buys us why you can have a world where stock indexes look fine on the surface, and yet funding markets start charging a premium. Because the constraint shows up first where the pros live, in repo and secured funding, in the spread between overnight rates and the willingness to intermediate treasury supply, in how quickly a dealer steps back from making tight markets. But that's not the part that matters most. The hidden detail is the shock absorber that used to sit between cash and risk has been shrinking, and the system has to relearn what it feels like when that buffer isn't there. For a long time, a huge amount of cash sat in the Fed's overnight reverse repo facility and acted like a sponge, cash that could shift around without immediately stressing bank balance sheets. As that facility drained down over the last couple of years, the sponge got smaller. At the same time, treasury bill supply grew, money market funds had plenty of alternatives, and the system became more sensitive to the exact dates when balance sheet is scarce. That is why you saw the Fed's own research highlight quarter-end episodes where SOFR, the secured overnight financing rate, popped meaningfully above other administered rates, and even exceeded the rate paid on reserves. That's not supposed to happen in a world of abundant reserves. It happens when the market is saying, I will pay up for financing because the balance sheet is rationed. And when the most important overnight secured rate starts doing that around quarter end, it's a warning label. Because if this one level breaks, the math changes. Here's the simple chain. Dealers and some leveraged funds finance treasury positions in repo. When repo is cheap and balance sheet is available, it's easy to carry positions. When repo gets expensive and balance sheet gets scarce, especially around quarter end and year end, carrying becomes painful. And when carrying becomes painful, somebody has to reduce. Reduce means sell, or reduce means stop bidding as aggressively at auctions, or reduce means pull back from tight bid-ask spreads. And suddenly, the market feels less liquid even if nothing dramatic happened in the news. That's why people get blindsided by moves that look like they came out of nowhere. They didn't come out of nowhere. They came out of the funding channel. And that's where the real pressure starts. Now zoom in on the calendar, because timing is not a footnote here. It's the catalyst. The final week of December is where liquidity thins. Trading desks are staffed lighter, risk limits are tighter, balance sheets are managed for optics, ratios, and regulatory snapshots. If you've ever watched a market fall through levels that should hold with almost no resistance, it's usually because the marginal buyer stepped away, not because everyone suddenly hated the asset, because the people who normally absorb flow decided, not today, not into year end, not when the balance sheet cost is higher. And the scary part is, it doesn't take a lot of selling to move price when the marginal buyer disappears. That's why the warning matters right now. Year end is a mechanical event. The system's behavior changes whether you're emotional or not. But here's the catch. Once a move starts in thin liquidity, it can feed on itself because price moves trigger risk models trigger deleveraging, and deleveraging creates more flow. That's reflexivity. And it can turn a small plumbing squeeze into a larger price squeeze. But that's not the part that matters. The part that matters is whether the system has enough slack to absorb it without forcing the Fed S-hand again, or causing a violent repricing across risk. So let's look at the evidence stack, not just one argument. First proof point. The Fed's own balance sheet posture shifted. When a central bank chooses to stop runoff earlier than expected, it's acknowledging something about reserve scarcity and money market functioning. It's not the same as cutting rates. It's subtler, but it's a constraint signal. Second proof point. Quarter-end and year-end repo dynamics have been showing recurring pressure. The spread between SOFR and the overnight reverse repo rate has jumped around reporting dates, sometimes by meaningful chunks. And the Fed has explicitly studied and discussed why it happens. Banks demand more liquid assets, dealers manage balance sheet, and the market pays up for financing. Third proof point, the weekly aggregated bank balance sheet data, H8, shows how big the system is, how deposits and borrowings shift, and how cash asset levels move over time. You don't need 1 week's print to tell you everything. You need the direction and the sensitivity. If cash assets are trending lower while borrowings or other funding sources rise, that's not bad. It's a sign the system is leaning on different channels. And when those channels hit quarter-end constraints, the marginal cost spikes. Fourth proof point, the Treasury market is still massive and distribution matters. If the government leans heavily on bills and uses buybacks to manage liquidity and market function, that's another tacit admission that the market's capacity is not infinite. It's not a conspiracy, it's incentives and mechanics. The market can digest supply until balance sheet costs make it unattractive. Fifth proof point, current price context sits right where these mechanics can bite. The 10-year yield is hovering a little above 4, 1% into this final week, and that level matters not because it's magic, but because it's where positioning, carry, convexity, and auctions can suddenly interact. In other words, it's a level where plumbing stress can show up as market volatility very quickly. And the next detail is what flips the whole setup. The market's calm is conditional on intermediation. Intermediation is conditional on balance sheet. Balance sheet is conditional on constraints and incentives. That's why bank balance sheets just changed as a warning. Not because banks are doomed, but because the system's pricing of risk changes when the marginal dealer says, "I'm full." Now, let's get practical and walk through one mechanism clearly, because you're not here for vibes. You're here for how the machine works. Repo is the financing market for treasuries and other high-quality collateral. In simple terms, you post collateral and borrow cash overnight, or for a term, and you pay a rate. If you were a levered participant running a basis trade, owning a treasury and shorting a futures contract against it, you'd redoing it because the spread pays you. The spread is your carry, but your carry is only real if financing stays cheap and stable. If the repo rate jumps around year end, or if your haircut changes, or if your lender tightens terms, your carry collapses. Then your trade goes from, low risk income to, why am I holding this into an illiquid period? That's when you reduce. And the act of reducing creates the exact price action that scares everyone else. But that's not the part that matters. The part that matters is that the basis trade is not some tiny niche. It interacts with treasury liquidity. It interacts with futures markets. It interacts with dealer balance sheets. When balance sheet is scarce, the basis can widen. Futures and cash can decouple briefly, and the market sends confusing signals. People mistake that confusion for the bond market is broken. It's not broken, it's stressed. And stress changes behavior. Now throw in options and hedging behavior, because this is where reflexivity gets sharp. In rate markets and equity markets, dealer hedging can amplify moves when liquidity is thin. If there is a cluster of options exposure around a certain yield level or a certain equity index level, dealers hedge by buying or selling the underlying. When price moves through those levels, the hedge flows accelerate. That S how you get, it fell too far too fast, or it ripped higher with no news. It wasn't no news. The news was positioning. The news was gamma. The news was hedging. And the calendar makes it worse because fewer participants want to take the other side. And that's where the real pressure starts. But we're still missing the hidden detail that reframes the story. Here it is. The Fed's decision to stop runoff on December 1st is the system admitting that reserves are closer to the minimum comfortable level than the public thinks. You don't need a crisis to care about that. If reserves are less abundant, then small frictions create bigger rate moves. If small frictions create bigger rate moves, then risk assets get whipsawed because discount rates and funding costs jump around. And when discount rates jump around, the market starts repricing duration-sensitive assets first. Long duration equities, credit, high multiple tech, and anything leveraged to easy financing. That's why the warning is broad. It's not just a bank story, it's a market structure story. And the next detail is what flips the whole setup. Most people track the Fed funds target range and think that's the whole story. It isn't. The story is the relationship between administered rates and market rates. When the effective Fed funds rate creeps higher relative to the rate paid on reserves, that's the system telling you reserves are more valuable. When SOFR trades rich to the overnight reverse repo rate around quarter end, that's the system telling you balance sheet is being rationed. When those relationships move in ways that require study, discussion, and policy tweaks, you're watching the plumbing shift. And plumbing shifts show up as volatility, not as an elegant headline. So what should you be watching this week and into the next two? You're watching for forced behavior. You're watching for the market to start charging a balance sheet premium. You're watching for the telltale symptoms. Overnight rates that refuse to behave. Repo prints at the top end of the range around the last business days of the year. Wider bid-ask spreads in rates and credit. Softer depth in Treasury order books. And sudden moves through technical levels that look irrational until you remember it's thin liquidity. But that's not the part that matters. The part that matters is what those symptoms force participants to do. If funding is tight, levered players reduce. If levered players reduce, dealers absorb only up to their constraints. If dealers are constrained, price moves more for a given flow. If price moves more, volatility rises. And volatility is the weapon that takes retail out at the worst moment. Which brings us to the psychology shield, because this is where most people lose money even when they're right about the macro. Volatility has three classic tricks. First trick, it makes you believe the last move is the next move. A sharp sell makes you feel like it's breaking. A sharp rip makes you feel like I missed it forever. Both feelings are traps. Second trick, it compresses time. It makes a 2-week move feel like a permanent regime change. Third trick, it hides the mechanism. It floods you with headlines so you don't look at the plumbing. Your defense is not prediction, your defense is process. Separate trend from noise. Noise is a year-end squeeze that reverses in the first week of January when liquidity returns. Trend is when the plumbing signals persist, when funding premiums remain elevated, when spreads stay wide, when the market can't return to orderly trading after the calendar passes. And that's where the real pressure starts, because if the plumbing doesn't normalize after the calendar, the system is telling you something deeper changed. Now let S anchor this with the two scenario lens so you don't OT get hypnotized by one narrative. Scenario 1 is the controlled pullback and retest. In this world, year-end balance sheet constraints cause a temporary funding premium, markets whip, some positions are forced out, and then early January brings normalization. Liquidity returns. Dealers reopen risk. Bid-ask tightens. Depth returns. Rates settle back into a range. Risk assets stop acting like they're being pushed down a staircase. In that scenario, the warning was real, but it was a timing event, not a regime shift. Scenario 2 is continuation squeeze and gap risk. In this world, the year-end stress triggers a chain of de-risking that doesn't stop cleanly. Funding stays jumpy. A few auctions or large flows meet a thin market. Technical levels break in rates or equities, which triggers hedging flows and more forced selling or buying. You get a gap move when liquidity is absent. And even if the thesis is correct, price can whip violently both directions. That's important. Being right about mechanics doesn't protect you from volatility. Your position sizing and time horizon do. But that's not the part that matters. The part that matters is what confirms which scenario you're in. Confirmation is not a headline. Confirmation is behavior in the plumbing after the calendar passes. If we're in scenario 1, the stress fades quickly in the first sessions of January. If we're in scenario 2, it persists or repeats on the next stress point. So here's your near-term roadmap, clean and concrete, without fake precision. Watch the last business days of the year and the first few trading days after. Watch overnight funding behavior. Do you see the secured rates and related spreads calm down, or do they keep printing stress? Watch Treasury market depth and volatility. Do yields move in an orderly way, or do they lurch through levels with little resistance? Watch credit spreads and risk sentiment. Do high yield and credit indices hold up, or do they begin widening as financing becomes more expensive? Watch the equity market's reaction to rates. Do long duration stocks stabilize, or do they continue reacting violently to every basis point move? And watch the cross market tell. If gold and silver are making dramatic moves around the same time, don't treat it as prophecy. Treat it as a stress thermometer. Metals can reflect currency anxiety, inflation expectations, or simply a search for assets less dependent on the banking funding channel. But they can also get whipsawed hard when liquidity is tight. That's why you don't use one asset as your whole story. You stack proof, you watch confirmation, you manage risk. And that's where the real pressure starts. Now, about levels, because you asked for what matters without pretending we can forecast to the decimal. In rates, the zone around the low 4% area on the 10-year is a psychological and positioning zone into year-end. If yields push higher and hold above that zone while funding stress persists, the market is repricing the cost of capital and it can spill into equities. If yields drop sharply, but the move is driven by forced de-risking, you can see a violent rally in duration that later retraces. The level itself is not the holy grail. The behavior around it is. In equities, the level is whether rallies are being sold immediately or whether the market can hold gains even as rates wobble. In credit, the level is whether spreads stay calm, because credit is the canary when financing is tightening. But the next detail is what flips the whole setup. The setup isn't rates up, stocks down. The setup is intermediation capacity. When intermediation capacity is constrained, correlations can break. You can see bonds and stocks sell together briefly. You can see safe assets behave like risk assets. You can see bizarre intraday moves. People will call it irrational. It's not. It's balance sheet math. Here's a quick way to feel it. Imagine a levered participant financing a large treasury position at a rate that is normally stable. A 20 basis point jump in financing around year end doesn't sound like much in daily life. In leverage land, it can be the difference between positive carry and shut it down. And when multiple players face the same math at the same time, you get crowding. Crowding unwinds. Unwinds move price. That's why the warning is about behavior, not fear. Now let's connect this to bank balance sheets directly because the title demands it. The weekly aggregated bank data shows deposits, borrowings, securities holdings, and loan growth. Around periods of stress or changing policy posture, you'll often see banks adjust their holdings and funding mix. Not because they're panicking, but because they're optimizing under constraints. When runoff stops, reserve dynamics change. When reserves are closer to the comfort floor, the system becomes more sensitive to shifts in deposits and treasury issuance. When money market funds have options, bills, repo, other short-term instruments, cash doesn't automatically flow where it smooths the system. It flows where the yield is. That means the automatic stabilizer is weaker, and the central bank has to be more attentive. And the fact they've already adjusted tells you they're attentive for a reason. But that's not the part that matters. The part that matters is what banks and dealers do at the margin. If they're willing to intermediate, markets behave. If they step back, markets lurch. And year-end is the time they're most likely to step back, even if everything is fine. So the warning is not an apocalypse, it's a calendar meets plumbing risk. It's the kind of risk that hits portfolios because people don't plan for it. They plan for CPI prints and rate decisions. They don't plan for balance sheet scarcity on a quiet week, and that's where the real pressure starts. Now let's talk counterpoints so you don't get trapped in one-sided thinking. The counterpoint is that the system has tools now that it didn't have in 2019. There is a standing repo facility. There's better monitoring. There's more awareness of quarter-end behavior. The treasury market has evolved, and participants know to anticipate year-end dynamics. Those are real stabilizers. Another counterpoint is that rates have been high enough that money market funds and cash-like instruments are attractive, which can keep cash within the system and reduce wild swings. Another counterpoint is that banks' capital and liquidity positions, in aggregate, can look strong even when the plumbing is tight at the margin. All of that can be true. And still, the warning can matter, because margin dynamics are what move prices. The system can be healthy and still experience violent repricing when intermediation is rationed. It's not a contradiction. It's how markets work. And the next detail is what flips the whole setup. When you hear someone say this is manipulation, you don't need to join that story to respect the incentives. The incentive is to manage balance sheet and risk through the reporting date. The incentive is to keep ratios attractive. The incentive is to minimize the chance that an ugly mark hits your P&L at the wrong time. Those incentives naturally reduce risk-taking capacity. The market responds by repricing the ability to finance. That's not a secret cabal. It's a predictable pattern. And predictability is useful because it lets you plan. So here's how you plan without getting emotionally hijacked. First, you define your time horizon. If your horizon is days, you respect the calendar and you expect gaps. If your horizon is weeks, you accept that year-end can produce fake-outs and you look for confirmation after liquidity returns. If your horizon is months, you focus on whether the Fed AS shift in balance sheet policy is signaling a new steady state of reserve scarcity that will keep volatility higher than the crowd expects. Second, you define your invalidation. What would prove the warning is not translating into market stress. A quick normalization in funding spreads, orderly auctions, stable credit spreads, and a market that can digest flow without lurching. What would prove the warning is becoming real. Persistent funding premiums beyond the year-end window, repeated stress on subsequent dates, and widening spreads that stay wide. Third, you avoid overreacting to one candle. Trend signals come from repeated behavior, not one dramatic session. Noise is loud, trend is persistent, and that's where the real pressure starts, because volatility will try to convince you noise is trend. Now, what comes next, in the most actionable form, over the next week to 2 weeks, the market is likely to test liquidity. Either it wobbles and stabilizes, or it wobbles and cascades. If you see a sharp move in rates or risk assets during thin liquidity, don't let it force a decision at the worst time. Watch the follow-through. Watch whether the move is being confirmed by the plumbing. If it's not, it's probably a calendar squeeze. If it is, it's telling you the cost of capital is being repriced, and that matters far beyond 1 week. Watch the next policy communications and any signals that the Fed is monitoring money market conditions closely. Watch Treasury financing and the market's reaction to supply. Watch for the return of liquidity in early January and whether it actually calms things. And keep one mental model in your pocket. When the Fed stops runoff and talks about money market dynamics, they're not trying to entertain you. They're telling you the floor under abundant reserves is closer than you think. But that's not the part that matters. The part that matters is the checklist you can use in real time. Here it is, in plain language. Are overnight funding markets calm or jumpy? Are Treasury moves orderly or gappy? Are credit spreads stable or widening? Are dealers providing depth or stepping back? Are moves being reversed quickly after liquidity returns, or are they sticking? If you can answer those 5, you'll understand the tape better than 90% of commentary. Now let's close with targets and invalidation in a way that keeps you honest. Target in scenario 1 is not some fantasy number. The target is normalization. Spreads calm, depth returns, and the market stops acting like it's trading through molasses. In that case, expect a retest of any big move and a mean reverting chop as liquidity returns. Invalidation of the bigger warning is if funding premiums fade fast and Dawn and T reappear on the next stress date. Target in scenario 2 is a repricing. Yields and risk assets continue moving with forced behavior, not narrative logic, and you see follow-through even after liquidity should have returned. Invalidation of scenario 2 is if the first week of January reopens liquidity and the market immediately absorbs flow without stress. Simple, not glamorous, but it keeps you from being played by volatility. One last thing, because this matters for trust. I'm not telling you what to buy, I'm telling you what to watch, because when the plumbing shifts, the smartest trade is often not a trade. Positioning your mind and your risk so you don't to get forced into a bad decision when the market gets loud. If you're the kind of investor who cares about mechanisms instead of slogans, you're already ahead. Stay in that lane. Track the balance sheet signals, respect the calendar. And when the market tries to bait you with a headline, remember, the real headline is the spread. The real headline is the funding cost. The real headline is whether the system has slack. If you want, in the next video we can map how this interacts with specific assets, treasuries, gold, bank stocks, even the dollar, using the same framework, plumbing first, narrative second. And if this kind of straight, mechanism-driven breakdown is your style, you'll fit in with the people here who don't get shaken out by noise.